Hello and welcome to today's personal finance show here on Dublin City FM with me, Paul Merriman from askpaul.ie. Today's show is all about mortgages. We're dedicating it to mortgages. There's been so many changes in the last couple of weeks in relation to mortgages. We thought we need to address it on a full show. So today's show, I'm joined in studio by Shane Cullen, who is the head of mortgages at askpaul and Fairstone.ie. Right, let's start. We've seen newer mortgages come out with a new product, and we've also seen Avant as well. So let's start with newer.
There was a couple of really exciting new products announced over the last couple of weeks, Paul. So first of all, Nua announced their new Freedom mortgage product. So basically this is a product to support so-called mortgage prisoners, okay? So people who are currently in alternative repayment arrangements with their mortgage provider. So what Nua have said that eligible customers who have maintained an alternative repayment arrangement for more than 5 years will be eligible to switch their mortgage. And
this is massive. This is absolutely massive.
Yeah, they're finally going to be in a position to secure a fresh start for themselves, essentially.
So let's give people an example. So there's a lot of people out there that would have been Bank of Scotland customers, Permanent TSB customers, Bank of Ireland, AIB, you name it, KBC. And if you went into arrears during the financial crash or financial crisis, typically speaking, or even after that, you would have ended up probably going to somewhere like a Mars or
Pepper, yeah.
And then if you had a variable rate, when the variable interest rate started to increase in 2022, you might have been a 4% rate, you could be on a 9 or 10% right now.
Yeah, the bulk of these customers would be paying 8-9% in their mortgage.
Which is absolutely horrendous, like it's excruciatingly high. So before, what the problem for these customers was, for listeners, Shane, is that those guys couldn't move because they were technically not in arrears, but they had maybe a split mortgage where they had money in the cloud.
Exactly. They might have had a portion of the mortgage might be warehouse, or they might be on an interest-only repayment arrangement, and it could be coming up to the end of that agreement, and they don't know what they're going to do. They're going to be left sitting on capital and interest repayments at 8, 9, 10%.
And also, life might have changed. That you might have one person not working now as a couple. They might have had kids. Like, as in, it's nearly 15, 20 years we're talking here. So substantial change in people's circumstances.
Exactly. Yeah. So look, what Nua are doing here now, no other lender in the Irish mortgage market is trying to support these customers at the minute. So Nua are bringing out a product specifically designed to support these customers in alternative repayment arrangements and give them an out, essentially, and make life that bit easier for them and take the stress off their back. It's a really good option. Yeah, so the main features of this product is max loan amount to be 750 grand. You can do a max mortgage term of 40 years as well. So if you might only have 20 years left to go on your mortgage. Once it reverts to capital and interest, the monthly repayments are going to shoot through the roof. So it's an option with this newer product. We extended the term.
So you can extend the term massively and also reduce your repayments, which is great for people. And then if it was part of a financial plan and you had a pension, the pension lump sum might clear that mortgage in the future. Brilliant.
Exactly, yeah. And the fixed rate is 5.25% on a 3 or 5 year fix. So look, relative to what's on the market, it is quite a high interest rate, but when you're putting it against 8 or 9%,
or even more,
again, it's such a good option for clients. So
And what you could do is, if you came back into the newer piece and just say you went on the 5.25% rate, you're paying that down for the next 2 to 3 years, you could potentially switch back to one of the main pillar banks and get back onto the cheaper rate. So it's like a stepping stone, really.
Absolutely. You've demonstrated you can meet those repayments on capital and interest for at least 3 years on that 3-year fixed rate with Nua. Then it opens up doors of all the lenders.
Exactly. Yeah. No, look, I think it's great news, because that mortgage prisoner stuff is nonsense. I think the central bank should have stepped in and helped people more in that situation as well, because those customers didn't do anything wrong. It was a financial crash. But yet they were left really high and dry as banks exited the country, and as our own banks cleaned up their loan book and just dumped all these over the likes of Pepper. And the taxpayer paid out to do this.
Absolutely, the amount of stress caused on people to have that amount of debt hanging over you.
100%. I couldn't agree more. I think it's great news. And so if you are one of those people that have money, have a mortgage in Pepper or Mars Capital, another one after what's the other one, Shane? It's just Mars and
Mars and Pepper
are the biggest ones. So if you have those situations where you feel like you're trapped, you can't do anything, now you can. So get in touch with Shane and his team over at askpaul.ie, get a consultation and get some advice. Right, next one that's exciting this week, Shane, is Avant.
Yeah, so the other one is Avant Money. They launched a new flex mortgage product, which is a really, really exciting and innovative products that they're after coming out with. It's basically a variable rate mortgage that tracks the Euribor rate. So for anybody who doesn't know what the Euribor rate is, it's a rate to which the leading financial institutions in Europe lend to each other.
Yep.
Okay, it changes daily, but what Avant Money have done is they're taking a 12-month average of that rate.
Okay.
And that's creating what they call their benchmark rate for the product. So there's two parts to the product. There's the benchmark rate and then there's a margin, okay?
So we know the benchmark rate today is what, 2.34?
It's 2.41%. Yeah, is what it is at the minute. Now the margin that they add on depends on the loan to value of the product, of the mortgage. So if it's less than 80% loan to value, it's 0.9% is the margin that they add on. And if it's greater than 80%, it's 1.1%.
Brilliant.
Okay.
So you're looking at, they're saying, just say that 0.9% margin, okay? Just under 1% is what Avant are going to take off this. So the other 2.4 goes to that interbank where they're borrowing from, really.
Yeah.
Which I think is really competitive, really good. That gets you up to, that 3.3%. It's a variable rate.
Variable rate. It's Ireland's lowest variable rate now when this is launched on the 1st of April.
Yeah, that's amazing.
Yeah, so, but...
People should think about launching stuff on the 1st of April, right, before so we'll just say that to Avant. Yeah, there's only one thing about
it. They told me it's not good.
Go for a second, lads. Just do it by one day. But okay, that's 3.3%. The flexibility is you got that rate for 12 months, and then 12 months time you'll be told what the Euribor was for the previous 12 months, and if the Euribor has gone down, your mortgage goes down. If it goes up, it goes up.
You're getting the best of both worlds with this product. So you're getting all the benefits of a variable rate. You can make extra repayments whenever you want. You can clear off lump sums. You can switch to another product at any stage as well if you want. But the rate is also essentially fixed for 12 months. You're also having the security of knowing that your monthly repayment and the rate's not going to change for that 12-month period. Then at the end of the 12 months, that benchmark rate, it resets. And then you go again for another 12 months once you don't decide to switch out of the product.
Perfect.
That point.
Yeah, the only thing I would say is that for me, the overpayment's not an option, not really a big seller for me, unless it's unless you have a redundancy or an estate coming to you from an inheritance point of view, where you almost clear your mortgage. Because Advent already are the best in the marketplace for letting you overpay your mortgage, or even on their one mortgage product, a different product. You can overpay up to 10% of the capital outstanding. So if you have a 400k mortgage, you can make a 40 grand payment without any penalties, which is like compared to the Irish banks and the...
Also what Avant Money are doing here is they're catering to all people's needs. So whereas some banks have come out with some great headline rates over the last 12 months, like you've AIB with their 3% green, less than 50% loan to value rate. Yeah, but if you fall outside of that, there's nothing. Whereas Avant now, they have their one mortgage product still, they have their shorter term fixed rates, they have Ireland's lowest variable rate. So there's something for everybody there. And the important thing to remember with them as well, all their rates start with a 3, which the other lenders are going into 4.5, still 4.6%. And
I did a podcast for somebody today earlier on, and they were asking me about favourite banks, and which was hard to ask me because it's a bank hater. But anyway, I was talking about Avant, and I was saying, the person who was interviewing me said, the first time they see me on social media was about 7 or 8 years ago, and I was in Spain doing a video. So I did a video in Spain on Snapchat back in the day, and we started the Ask Paul brand. And I was outside, I think it was Santander Bank, and I was talking about mortgage interest rates for first-time buyers over in Spain at that time, at 1.5% fixed for the whole year mortgage. So the fixed rate, and our first-time buyers were getting 2.8 to 3.5%. And my video was highlighting the inequality in the European Union between what we were being charged in Ireland versus Spain. But Avant are owned by Bank Antir, which are a Spanish bank. And the other thing I was saying on the interview was that for years we had people say to us, can I get a mortgage in Spain or Germany that's much cheaper and put up my property in Ireland? And you couldn't because it's just too legally messy. But now you're getting the Avant, they're giving you the Spanish type products in Ireland, and they're competing massively against the Irish banks.
Exactly, it's so
it's great.
Progressive, and from a broker perspective, it's given us more products to offer to our
100%. Yeah, I think it's phenomenal, and I think it puts pressure on the Irish banks, those main three pillar banks. It puts pressure on them to become more innovative, get their rates down lower. So the more competition and the more innovation like this is ultimately brilliant. And I don't think the banks will come near them, by the way, any of the Irish banks, but it does give the client more options.
Yeah, now a lot of the headlines during the week were saying, track mortgages are back. It's not a tracker.
I've seen that. Charlie Weston's article in The Independent was trackers are back after 17 years. And actually, Avant are quoted in the article to say it's not a tracker. I was like, what the... So I know, look, Charlie's obviously very good at what he does from a personal finance point of view as a journalist. But I was annoyed at that article because I thought it was headline grabbing to just make people read the article. I clicked through it to make it think that trackers were back. This is not a tracker mortgage, nowhere near a tracker mortgage.
No, and there's such a stigma still around tracker mortgage.
Exactly, yeah. So, and then, sorry, just for everybody else, that Euribor rate of that 2.4 we're talking about, that doesn't move as much because that's not set by the European Central Bank. So the European Central Bank is there to keep inflation under control. They'll use interest rate increase and decreases to manage inflation. Where that interbank kind of lending rate that the Euribor is, that's it's way more, it's not as volatile. It won't go up and down as much as the ECB.
It will still go up and down a bit.
Yeah, but it's not I'm getting 4 cuts in a year, 4 increases.
No, exactly. And that's the main difference between this and the tracker rate is the tracker rate follows the ECB. And anytime a rate cut came in, tracker mortgage
or automatically
hit straight away.
Or an increase.
Yeah, exactly. Whereas with this, you full control over the product. You can keep an eye on the Euribor rate, what way it's moving, and if you decide that it's get to a stage where it's moving too much, you can jump out of the product and fix
it
at any point.
I'm not going to say criticism I have of this product because I think what Avant done great is that I would probably still be looking at the one mortgage product because the one mortgage product, as we know, is 3.4%. It's fixed for the life of the mortgage, and this is coming in currently at 3.3 something. So for security. And you can overpay 10. Not many people can pay 10% of their mortgage off tomorrow. Like, and also got walk with 30, 40 grand to pay off. So I do think it's great flexibility. It's a great product, don't get me wrong. But you're right, I think it's just another tool for us to use for clients, isn't it? It's just another product that we can advise them on. You need a bit more flexibility.
Exactly, and variable rates, to be fair, are becoming more popular with clients because clients are
terrified. Yeah.
Well, they're becoming more rate conscious as well, and they can see rates are starting to come down. A lot of them don't want to fix long term. They're under the opinion that rates might come down a little bit more, and with a variable rate, you have the flexibility of being able to move on to a lower fixed term rate at any stage as well if there is a cut.
Shane, interest rates. We're talking about interest rates anyway, about Avant and newer. So mention that Avant rate there, 3.3. You mentioned the green rate with AIB from a 3% or under 50% loan to value with 3%, which isn't really practical for the majority of customers. Where are interest rates? Like what's your kind of, so clients are coming in, typically, let's say first time buyers are coming in, they got the 10% deposit. What are we doing with them? Like what's the kind of main recommendation you're seeing? Obviously we do a lot of Bank of Ireland business as well. It's been quite competitive and quite good over the last number of years.
Yeah, for that 80 to 90% loan to value, which most first time buyers are in, Bank of Ireland would generally be the strongest, especially if it's a mortgage over 250 grand. They have their high value mortgage proposition where you get rates as low as 3.4% on 3.1% on a 4-year fixed rate with them, which would be really strong in the market.
Well, it's strong compared to those, but the problem is in 4 years you know where the rates are going to be. I think for listeners, my main concern is that I think people automatically think that rates go up and then they automatically just come back to where they were, and they're never going to zero. And if the ECB is trying to get to 2% as an inflation of 2%, your rates are probably, I think, benchmark where they are now. You might get 1 or 2 movements, but not major. I think there's a risk, especially with Trump and tariffs and EU. I think of inflation or a recession. I think you might see if inflation goes back up and we don't get a recession, we have what's called stagflation. The European Central Bank might be forced to put rates back up again. So that 3.1 is great for 4 years. I personally would still go 3.4 fixed for 30 years or 25 years. But it's case by case basis, obviously.
No, 100%. Like that one mortgage product with Avant Money, like again, they're the only lender in the market that's offering rates that long at the minute. And to have that peace of mind and comfort that your monthly repayment, those rates not going to change.
Goes back to my video on Spain, 8 years for giving out about Irish banks.
Fixed rates are like 100% still dominating the market. Like that might change a little bit now with Avant Money's new product that they're after bringing out, but because variable rates have been pitched much higher.
They have even much higher. It's over 4%. Right?
Yeah, like AIB's currently was the lowest one at 3.75%, but that's only if you're able to put more than 50% into the purchase. Like if it's an 80 to 90% loan to value one, the best rate is 4.15%.
I said less than 5% of our client bank that comes to us is in that situation. Probably less than 2% truth be told in that situation. Shane, cashbacks. Let's talk about cashbacks for consumers because obviously, well, especially for first-time buyers because it's such an expensive journey. Let's talk about cashback. What's on the marketplace?
Yeah.
What are people doing? Are they taking the cashbacks? Are they attracted by the cashbacks?
100%. Like the kind of main lender for cashback that we're seeing people go to at the minute, it would be PTSB. So they're giving 2% cashback on some of their green rates as well, which the other lenders don't do. So
Right.
they're not offering cashback on green rates, whereas PTSB are. So they'll give you 2% of the balance, plus they give you 2% of your monthly repayments back as cashback as well. And you can get rates potentially as low as about 3.5 on a 3-year fixed rate with them. So that would be strong if it's, say, a 400 or 500 grand mortgage, and you're going to get 10 grand cashback. And
like, as you're talking, I know I'm going to say this because obviously we are the business and Ask Paul, but as I'm listening to you and how knowledgeable you are, and obviously I think you're one of the best in the country what you do, it's almost, I'd love to shake anybody that's just walking into a branch to go for a mortgage today. As in, there's so much offering out there. Like if you're going for a mortgage and you just walk into AIB, Bank of Ireland or PTSB directly, it's madness. Like, it really is madness when you look at all the product out there and all the offerings and the knowledge. Well, you just don't, obviously you walk into PT, you're just going to get a PTSB mortgage. That's it. You might have a great mortgage advisor. You're probably the best in the country, but you're sticking out.
Yeah, well, probably after our conversations with you, we're going to assess you, your current situation, what you're looking to do, the types of properties you're looking to buy, how much you're going to be borrowing, and then we'll make a recommendation based on those circumstances and who's going to fit you best.
I also love the fact that we'd be able to show the client the total interest charge as well. So you might have 2% cash back here, but this is how it actually pans out over the cost as well.
Exactly, and
they get the true figures.
Cashback offers can be great, especially for first-time buyers who, the majority of them are using all their savings up on the deposit. So they're completely wiping themselves out. So if you can get an additional lump sum of cash after drawdown, obviously it's going to be great. But if you look at it over the life of the mortgage, with the extra interest you're going to pay, you will pay that cash back and then some at the end of the mortgage if you look at it over the life of it. So it's really managing those priorities. Is it getting the lump sum of cash afterwards, or is it looking at the mortgage over the 30
I think for most first-time buyers, it has to be back to that. And then, sorry, it has to be back to that cashback. Talking about first-time buyers there with cashback, switchers and cashback, what's in the marketplace?
Yes. So Avant are offering 1% cashback on all their fixed rates. So the one mortgage products you get 1% back on, you get 1% back on their shorter term fixed rates as well. With Bank of Ireland, apart from their high value mortgage rates, they give you 2% cash back on, so rates are jumping.
Or the green rates?
No, they do it. So they have their eco mortgage products. So, but you don't qualify for the high value mortgage rates with cashback. It jumps up a bit. You're looking at about 3.8.
You're basically paying for your own cash, but it is needed sometimes when people are doing these things, which is always
exactly. Haven will give you 3% cash back then, for switching to them as well, cover your legal costs.
So Shane, going to the questions, and thanks for agreeing to stay on for this, because I know the full show is dedicated to mortgage, which is great, but I do appreciate your time. Okay, the first one in is fixed mortgage better than the flex? And that's obviously that flex from Avant, someone's asking.
Again, it's your personal needs and priorities. Like, do you want that flexibility of being able to clear off lump sums? Do you want to be kind of in full control of your mortgage? With a fixed rate mortgage, you're more than likely going to be fixing for most of them it's 3 to 5 years with most of the lenders. So at least you've got peace of mind for that period of time. But with the flex mortgage products there, you've got the best of both worlds. So
yeah, you do. And you can have the option of getting back into. I think, to me, I'd always explain the difference between fixed and variable to clients is almost like your risk profile. Like, if you're going to have a little bit more of a higher risk profile, you might go for the variable, see if rates go down next year, so you can get a cheaper fixed. And if you're kind of not obsessed with it, but if it's going to be something that you're really interested in and trying to beat the bank almost, it's a really good product. I think if you're someone that's more cautious and more nervous, the one mortgage product's better, because you just get a rate today at 3.4 and you sleep for, next 25, 30 odd years. You know what you're paying. It doesn't make a difference what happens in the world. Your rate.
Exactly, and you can chip away at it as well.
Exactly, if more comes in. So it is a good question. Okay, my mortgage is with Pepper. What are my options? And that comes in from Anne-Marie. So Anne-Marie spoke with us earlier on. It's newer mortgages, and they'll let you switch. Yeah,
exactly. I'd book in for a consultation where you can just assess that you've been doing everything you need to do to meet their criteria for it. But once you've been meeting your alternative repayment arrangement for 5 years, then you should be fine to look to switch over them.
The next question is from Ella. And Ella, thanks for asking this question. Although it's what I would probably call a basic question, the reason we started Ask Paul all those years ago is to help people understand. But you're saying, can you switch your mortgage to a different lender? Yes, you 100% can, and you should be looking at the other lenders. But I think there's almost Irish people, when it comes to banks, have this inertia where you get your mortgage, you stay with that bank. And I know there's a little bit of work in switching, obviously, but you could be saving potentially tens of thousands of euro in most cases if you switch to a cheaper lender. Also, look at what your existing lender is offering. But as
Yeah,
you've gone through there, there's
Most people would review their car and home insurance every year. It's the same with your mortgage.
€100.
Yeah,
And they ring around trying to save £100.
yeah.
This is tens of thousands of euros.
But not enough people review their mortgage. Now,
No.
I'm not saying you have to do it every year, but at least every kind of 3 to 5 years, I'd be looking at your mortgage.
100%, yeah. But it's at the end of every fixed rate period almost, you want to be having a consideration. If you draw your mortgage savings, for example, a wedding once-off fee, is that frowned upon by the bank? Carl, it's actually a really good question because not a lot of people understand this. And there's actually, again, another podcast during the week with somebody, and we were talking about this, but it's hard for first-time buyers because they get approved for a mortgage and they have to be really careful what they do because you could spend your money, not save as much, and then your AIP, your approval principal, runs out. You have to reapply, and you won't get the mortgage a year later because your affordability is gone or you spent the money.
Yeah, dipping in and out of your savings is frowned upon by most of the lenders when it comes to mortgage applications, unless they're once-off expenses that we can explain back to them.
And they're higher. So if you're buying a 500 grand house, you need a 50 grand deposit, and you have 80 grand of savings, you can take 30 grand out, no one's going to mind. But if you have 50 grand, you take 20 grand out and try and put it back in, before your mortgage, it's going to be frowned upon because you need to have that affordability. And
Yeah, exactly. It's the demonstrated affordability that it impacts if you're taking funds out of your savings. So it's just to be careful with that. Yeah.
Okay, paying interest only on mortgage for 12 months due to life. Any negative? Right, actually, that's a really good question again. A lot of people don't know you can take mortgage skips. So let's just talk about them quickly, Shane, if you don't mind.
So there's a number of lenders that offer what are called non-distress payment breaks. So these would be basically for life events like if you're going on unpaid maternity leave or going travelling for 3 months, or you're doing a lot of work to the house, you want to take a break from the repayment. So to basically give you a 3 to 6 month payment break, no questions asked. You just fill out a form at most of them, and they'll put that in place. So it gives you that breathing room for a 3 to 6 month period for those life events that come up. Great.
And then, sorry, back to actual Rachel's question then. Sorry, I know I took it off, but is there any negative to going interest only because of life? So I don't know what's happened, obviously, in life, but there's no real negative when you're not paying your capital. It'd be a little bit more difficult to switch that mortgage in the next 12 to 18 months.
Exactly. If you're looking to switch the mortgage, the majority of lenders, apart from NUA, will want to see you back on full capital and interest repayments for at least 6 to 12 months before you go.
Unless there was a valid reason of some sort of curveball that was kind of logical. Okay, let me see. Inheritance due will be enough to clear down the mortgage. Is it better or save this for our kids? Do you know what? You really need a financial planning consultation to ask that question. I've actually said to somebody during the week, we haven't done as many lives on Ask Paul lately because every time we do a live, consumers and our followers are getting way more financial knowledge than they were 5 or 6 years ago. So 5 or 6 years ago was like, is a fix better? What is this? What's a tracker? What's a fixed rate? How do I get tax relief? And you can just answer questions. Where now people are asking very specific questions. And it's very hard to give that over the air, isn't it, Shane? Because it's a case by case. Not technically speaking, if the money comes in, any type of lump sum comes in, whether it's inheritance or redundancy or whatever it is, you need a financial planning consultation to map out what your options are. The options are save it, invest it, put it to pension, get loads of tax relief, clear down the mortgage, take the mortgage repayment to put it into investments and pensions and all the good stuff. Which one you do will depend on your overall financial circumstances
and your risk profile, priorities as well.
Yeah, and your income and what your kind of goals are in life, and what your hopes and ambitions are. If you're someone that wants to retire early, I'd probably say that redundancy or that inheritance should probably be a little bit of overpaying the mortgage, a little bit of investing through a pension because of the tax relief piece. But you wouldn't put it all off the mortgage. It depends on the interest rate of the mortgage as well, the loan to value of the mortgage. There's just so many things to consider. But any of those kind of questions, get over to askpaul.ie and book in for a financial planning consultation or a mortgage consultation with Shane and his team. Remortgaging in November, any advice? Fix again. Sorry, get in for a consultation now. Rather than wait until November, first of all.
Yeah, and if you're remortgaging as well, it is a full new mortgage application as well. So you want to make sure you're doing all the right things in the build up to you submitting that application.
Very important advice, Shane.
Yeah, so like that, booking for a consultation now and we'll put you on the right track.
And as to the fix again question, Leanne, I, to be honest, I'm going to say probably yes, but again, depends on if you've a lot of cash coming in the future, redundancies, inheritance, or whatever it is. You might look at that flex with Avant, or else you might fix it with them instead. So you have a load of options around that, but yeah, I think you have a consultation, look at what's on the marketplace, and you can make up your mind when you draw down the new mortgage or when you switch. I think is a most important thing. Self-build mortgages allow for exemptions of 4.5 times salary ? So
Yes, they do. Once you meet criteria with the lender for it.
Right.
Yeah, now exceptions are all on a case-by-case basis with the lenders. There's a limited amount of them that they can give out each year. But once you're meeting their criteria and they have them left available.
Shane, you know all the lenders. Just say yes. Shane would get you one. Oh. Only miss. No problem. White case spaces. Positive equity, 100,000 plus, 30 years on mortgage, 33 years old. Any advice? From a financial planning point of view, Dario, I suppose, keep going. The fact that you have 100 grand equity in your house doesn't really mean anything, in my opinion, when you're in your 30s. Unless the value of the house is only 200 grand. You got 50% loan to value. So I'm not sure what the advice what you're looking for is. If it's, you have 100 grand equity, do I take it out? Do I buy something? Do I remortgage? Do I keep paying it down? You have 30 years left on the mortgage. You know, sorry, I'm not sure what you're looking for. But what you should be considering is, again, maybe a consultation to see where do you want to get to. Do you want to use the equity? Do you want to renovate the property? Do you want to put in solar panels? And like, what do you want to do? I suppose everything's an option, and having 100k equity sounds great, but if the value of the property is $1 million, it's only 10% equity, so you can't really do anything. If the value of the house is 300k, you got 30% there. You might be able to get a few quid out. Okay, do you need to restart 6 months of good record prior to switching mortgage provider? That's a really good question.
Yeah, it's kind of what we went back to the previous question, that like it's a full new mortgage application again, so they want to see how you've operated your accounts over the last 6 months.
You don't need the savings element because you've got the affordability.
Yeah,
that's what this is more about.
Your demonstrated repayment ability is there from the existing mortgage repayments. It's just to make sure that if you've got a savings account there on the side as well, and there's 20 grand, there was 20 grand at 6 months ago, that's reduced down to 12 or 13 grand. They're going to deduct that from your demonstrated affordability.
Unless it's being for a holiday once off or something.
Once off payments and stuff, so just be careful on that.
You need to be careful there as well. Let's say you have a mortgage for 300k and you're looking to switch and equity release another 100k to do an extension. You need to be able to demonstrate that you can now afford a 400k mortgage, not just a 300k. So let's say your 300 grand mortgage is costing you 1,500 quid a month. The new mortgage is going to be 2 grand a month. You need to be able to show an extra 500 quid savings for 6 months prior to doing it. Yeah. And that's what I'd always say to people: book in for consultation 6 months before doing anything, because it gives you that time frame to make sure you can square everything off. Yeah,
some of the lenders are starting to make it easier for people to switch as well. So it's reduced documents with Haven now. You only have to provide 3 months bank statements with them. With Avant Money, you only have to provide your current account statements to show where the mortgage's been paid from, and then that's fine.
So you don't need a Revolut statements and banks and
savings accounts.
Very good. Yeah, very good. So it is supposed to get better, which is great. Hubby has a mortgage, but I don't. Can I take out Avant mortgage in my name to finish the house? Hubby has a mortgage, but I don't. Can I take out Avant mortgage in my name to finish the house?
Now, if he's a mortgage, if he's on the mortgage that's secured against that house, then you can't take out a second mortgage in her name. He'd have to go on it as well.
Yeah, you'd have to go on it as well. But also, so I think maybe they're looking to renovate or do like a second mortgage. No, you can't. You need, it's one mortgage. If you have a mortgage on a property, that is the mortgage on the property. You could probably both join, switch the mortgage. And
you can remortgage and add
more money if you wanted from an equity release maybe, and that might do it. Next question in from Eve: want to buy out my dad's mortgage? Should I apply for a mortgage, first time buyer, or a loan? He has 50k left. Ooh. Okay, so the loan is going to be really high because you're going to get a 10-year loan. So it's not really high. It's going to be 5 grand a year plus interest for the next 10 years, say. Or if you want to do it quicker, it'd be 10 grand a year or 5 years for argument's sake. The mortgage would have a much lower repayment, but it'd be over 20, maybe 25 years. It depends on your cash flow. Just be careful here. If you're buying the property, if your dad's going to stay in the property and you're just helping him clear the mortgage, you need to do a loan. If you're buying the property off your dad and he's giving you for the 50 grand mortgage outstanding, you might have a tax liability, and you could get a mortgage or a loan. But if your dad's still living in the house and he's not transferring the house to your name, you won't get a mortgage. So you really just need to stick with the loan, right in the Shane?
Yeah, no, 100%. At some of the lenders, I mean, minimum mortgage size 100 grand as well. So it'll limit who you can go to on the mortgage side of things.
Okay, very good. Okay. So guys, thanks mate for all the questions. There was loads of questions that we couldn't get to. We will try and get them through the Ask Paul page over the next few days. So thanks a million for taking the time to put the questions in. Next, before we wrap up, I want to have a quick chat about AI. Again, this is through a podcast I did earlier on with somebody else in the week. Shane, mortgage market at the moment. Let's just talk about first time buyers and the length of time it's getting them to market. So something comes in today for a consultation. Let's just say it's a couple, and they get a mortgage approval straight away. We'll have an application in, get them approved next, say, just 2 weeks for argument's sake. So 2 weeks after AIP, they're going out to the market. How long is it taking, and what are we finding? And are we doing resubmissions, and are we doing, like, what, because I think people underestimate this side of the marketplace.
Yeah, look, it does vary, and like, obviously the bigger the mortgage you're taking out, the easier it is for those people in terms of securing properties and finding them. But the availability of property and supply here is still such a big issue that it can take 6 to 12 months for especially first time buyers to find somewhere that they need. So we're having to rework applications kind of every six months or so. Now you can be lucky. We've got clients who find a property and secure one within a couple of months. Getting AIP.
They're not that often though.
Well, no, so few and far between. But you're generally looking at least 4 to 5 months.
Okay. Now, the reason I want to talk about this is that I have got a concern. I've been thinking about this a lot in relation to, we're doing so many financial planning consultations, and a lot of clients are coming in talking about their kids buying property in the future. We've got a little lad, Archie, he's 2 in May. And I just think, this is not to scare people or to create fear, but with the advancements in AI, we're seeing companies going into the French market through AI and just buying up 100 million worth of property. And I think it's not going to be long before you start seeing, I know we've seen before kind of corporate companies come in and buy up estates. I think that's going to happen on steroids over the next few years, where you're going to start seeing AI just going into daft.ie, into myhome.ie, and actually being able to bid and buy these properties off market. And I don't think we're far away in Ireland from that move into the rent for life. I really don't. I think it's a market it's very attractive to foreign investment, and you can't stop foreign investment coming in if it's going to come in through AI.
Wouldn't you have a job here, Paul?
No, because there'll be people switching, Shane. So we'll be okay. No, but what I want to kind of express to people when they're listening to the show is that the mortgage market is a difficult journey, but I think it needs to be top priority. And the reason being that if you don't get a mortgage quickly, or you don't get a mortgage in the next, say, 5 years, and I'm right, the AI does come in and we end up being a rental society, which I think we're so close to being. When you get to retirement age, your pension is just going to be paying your rent in most cases, because you know how extortionate rent is, and it's very rarely in a society you see rents come down. So even if they're stuck for the same way they are today and you're 40 years of age paying $2,500 a month in Dublin, you know, you're going to be paying way more than $2,500 a month in 20, 30 years when you retire. So people, in my opinion, need to do whatever they can and double down as soon as possible to try and get on the property market, because although we have a bad supply at the moment, even supply increases, I think the curveball that's around the corner is AI. And I think it's hedge fund money, investors' money through AI just coming in. Like you could act, like typically speaking, AI could go into daft.ie today, scan the marketplace within 30 seconds and scan the rental market along with the property markets for sale and work out quickly to the yield of the whole marketplace.
It's scary, isn't it?
And the yield is absolutely massive for money. So I just think this will scare people probably, and it's not supposed to scare you, and it's not a sales ploy to get mortgages in through Ask Paul. This is just honest advice that if you haven't got a mortgage yet and you haven't got the property ladder, I see some people on TikTok and some people on Instagram talking about the property crash is going to come. It's not. And even the property crash does come, you still need somewhere to live. So if you are in a situation where you can buy, you think you can get on the ladder, the first step is that mortgage. I think get a consultation as soon as possible, get the mortgage application together. If something comes, try and buy it, and get yourself on the ladder. And like I said, I'm conscious of trying to not scare, but I do think if you don't do that in the next 5 years, you're going to be in a fairly awkward situation in our property market, which I think needs to be strongly taken into consideration.
Yeah, like we've had a good few clients who've come to us over the last kind of 12 to 24 months, and they were of the opinion, oh, it might hold off until property prices start coming down again. This was two years ago. And it has
20% up.
Hasn't happened. They're still either renting or still living at home with their parents, and it could be the same again now over the next.
And just to say on that, if you are rented, that's absolutely, if you want to rent, we're saying if you want to rent, that's fine. Your financial plan needs to say we're renting forever. How do we get a bigger pension? Or do we go buy a property abroad? If you're a single person, you haven't got enough incomes, you go on the housing list, just in case in 10 years, you can get a property. But if you don't go on the housing list for 10 years, and you come back to it in 10 years' time, you're going to have another 10 years waiting for the property.
Yeah.
So it's actually just having a conversation about housing. The housing's an absolute nightmare in this country at the moment. But what are your options as an individual or as a couple, and putting all the cards on the table today and being able to put a really robust financial plan in place to get you there whenever that is. On that happy subject, that's the end of the show. And I am sorry, because I know it is, like I said, it's a scary prospect. But when I see in the articles of what they're doing in France, and 100 million of property being transferred through AI, and you just look, like I said, AI could literally went to data today, take all the house values, take all the rentals in those areas, and be able to come up with the algorithm and say, right, this is a good 7 or 8% yield. Someone that has 100 million, a few hundred million, a billion, it's actually a really good play. And I think we're not that far from that happening. And then you'll only be doing switching mortgages. Which might be easier because the rules are a little bit more relaxed.
Yeah.
And it would be quicker business. Guys, that's it for today's show. Thanks as always for joining. If you missed it, it was all about mortgages. Do get back onto Spotify, search for Ask Paul and Dublin City FM. Try and listen to the full podcast. If it's you or your friend that's getting a mortgage, or your kids are getting a mortgage, or you have a mortgage, you think of switching, today's was absolutely jam-packed with great content from Shane. So Shane, thanks a million for joining me.
No worries. Thanks, Paul.
Cheers, guys. Have a great day.